All right, now that we've had our conversation about costs, by the way, this is part 3. Now that we've had a conversation about costs, we can start looking at analysis tools. All right, cost volume profit analysis, this is a definition right from the book, is the examination of the relationships between selling prices, sales and production volume, costs, expenses, profits, all those things, right? It's useful in decision making because you're trying to figure out what the changes in selling prices. Like, what if I change my sales price? What happens? What if I change what if I adjust my costs? What happens? What if I move into a cheaper factory and reduce my fixed costs? What happens, right? How many of a product do I need to sell in order to break even? All of these things are part of CVP analysis. All right, so just a little quick aside here. Let me steal this. Sorry, I'm not on my game here. All right, here we go. Let's see if I can steal this and copy and paste it over and be lazy. I just want to kind of make sure we're on the same page here. I should draw for this. All right. If we think about this, direct materials, direct labors, right? Those are variable. We've talked about that. And your factory overhead, all those things are part of your cost of goods sold. The other piece is that we have factory overhead. We know that direct materials is variable. We know direct labor is variable. We've talked about that. Factory overhead, though, is it variable? Is it fixed? Well, both, right? Things like electricity fall in the factory overhead. Those are variable. But property taxes, those are fixed. Rent would be fixed. So if that's the case, what we have to do is we kind of have to separate our factory overhead into the relevant pieces. All right? There's a cost that go both ways in these. So if we're looking at these CVP analyses, we have to make that separation for factory overhead. All right, so let's move on to the income statement. All right, so I'm going to pause you guys for a second. All right, so forgive me, this is a tad rudimentary, but it's how I'm just going to show this to you. All right, so if we have the traditional income statement, the one you're used to seeing, it's what it's called actually is the absorption income statement. You've got sales revenue, right, minus cost of goods sold. We know cost of goods sold is direct material, direct labor, and factory overhead. Ignore this little piece here for well, I'll get back to that in just a moment. But you've got sales revenue less cost of goods sold gives you gross profit minus your selling and administrative expenses, which are also called operating expenses. Gives you income from operations. Then you have plus minus other, right? Other income, other expenses. It gives you net income. That's what you've been seeing through financial accounting forever. Now we're going to look at things a little bit differently. We're going to look at something called the variable income statement. And the variable income statement does basically the same thing. I mean, at the end of the day, we get to the same net income number here. Not always, but for now we will. Well, don't worry, future chapter, it'll be a little bit different. But the idea is that we need to recategorize things based on the fixed and mixed conversations we've been having. Because in order to do projections, we need to know variable costs, we need to know fixed costs. So what we do is we kind of recategorize the income statement a bit. And we present it a different way, but all the pieces are the same. So we take sales revenue, still starting off at the same place, but now what we're doing is we're subtracting our variable costs. All right? We're subtracting our variable costs. So we don't just, I shouldn't even say cost of goods sold, I should fix that. I should say variable costs. There we go. We take our sales revenue, we subtract variable costs. Well, we subtract then direct materials, direct labor, and variable factory overhead, right? Because those are all variable pieces. But we pull the fixed factory overhead out of there because it's fixed, right? And again, these are going to be things like rent and property taxes and the supervisor's salary. Those are going to be fixed factory overhead items. They don't change based on activity levels changing. And then we're going to come down here, we're going to look at, and we have something new. We have a new term, sorry. Sales minus variable cost gives you a new term. It's called contribution margin. And that's going to be what you make on the actual product before considering fixed pieces at all. All right. From there, we're going to subtract fixed costs. Well, there's our fixed factory overhead is going to come on down here and be in those fixed costs. But we have other ones too. In these selling and administrative expenses, we're going to have variable selling costs and we're going to have fixed selling costs. We're going to have variable administrative costs. We're going to have fixed administrative costs. So what we need to do is we need to break that into those two pieces as well. So variable selling and administrative is going to come up here and get lumped in. And fixed selling and administrative is going to come down here and get lumped into the fixed cost piece. All right, it gives us income from operations. It's going to be the same number, and plus minus other income and expenses gives you net income. Okay, so what we're doing is we're just really categorizing them differently because we need them separated into those variable and fixed components we've been talking about. All right. Now, contribution margin is a new term for you, but it's going to be one that we're going to use a lot, like a lot. So let's get used to it. Let's get comfortable with it. Contribution margin is sales minus variable costs, all variable costs. Doesn't matter whether they're product costs or selling administrative costs, variable costs. As long as they're variable, they get subtracted. Another way to look at it is a ratio, right? Contribution margin over sales. And unit contribution margin, we're going to use that a lot as well. And unit contribution margin is basically contribution margin, but for one. So what is my sales price for 1 unit minus the variable cost for 1 unit? So unit contribution margin figures into quite a few of our calculations going forward. All right, so let's look at this first one, 5-2, Land and Company. It sells, there we go. Sells 160,000 units at $45 per unit. Variable costs are $27. Fixed costs are $9.75, and they want you to determine contribution margin ratio and unit contribution margin. All right, so let's take this piece by piece here. We've got to do the contribution margin ratio. So we just said that is, if you look above, contribution margin divided by sales. Well, we don't know the contribution margin, right? But we can figure that out. Contribution is sales minus variable costs. So you're looking at the sales. Well, we don't know sales. We have to actually figure out the math here. It's 160,000 units at $45 per unit. That is a sales price, which is $7,200,000. All right, and we're selling variable cost of 27 for 160,000 units. So 27 times 160. It's going to be $4,320,000. Okay, here I'll put times 60. Well, 160,000, so you remember where that came from. All right, so now we've got our contribution margin calculation. We've got $7,200,000 minus $4,320,000. I don't know why I put that separate for second parenthesis there. Okay, all divided by the sales number, which is 160,000 times $45 a unit. Again, that's $7,200,000 number. That comes out with a contribution margin of 40%. So basically, on every sale that we make, 40% of that is a contribution margin, or kind of like our profit, right? Sales minus variable costs, 40%. So if a product was $1 to sell, then 40% of that, right? Well, 60% of that are variable costs, and 40% are then our profit, if you will. Okay, before we look at fixed costs. All right, so for B, it's asking you for unit contribution margin. Well, it's easy. That's just for one. So we're looking at $45 per unit minus the $27 per unit. Our contribution margin is $18. So we basically earn $18 on every one that we sell. And C is asking you kind of to prove, well, income from operations. I don't know about a firm. Let's go over here to do that. Okay, so we have sales minus variable costs. Gives me contribution margin minus the fixed costs, gives me income from operations. All right, so our sales, we know that's $7,200,000. Our variable costs are $4,320,000. That makes our contribution margin $2,880,000. We subtract from there our fixed costs, which are, they tell us, $975,000. And our income of operations, $1,905,000. Okay, so that's the basics of how we use this. All right, now we're going to start talking about break even. Or we will talk about break even. I'll finish the rest of these up, I promise, in the next video, and that will be it. All right, so just one more to go.